Our next guest says this will be a good year for value stocks. Wharton School Professor of Finance Jeremy Siegel joins us now. Happy New Year to you, Professor. Good to see you. Why value stocks in 2024?
Well, David, I just looked at valuation, which I think is, ultimately the most important variable for returns. I was looking at the Russell 1000, which, divides into value and growth. The PE ratio of the Russell 1000 growth stocks is 31.3. The PE ratio of the Russell 1000 value stocks is 15.9. It's almost a 2-to-1 ratio. Now, that's not the record. The record was in 2000, but we know what happened after 2000. So, things could get wider, but ultimately they come more together. Now, they shouldn't be together. Growth stocks should have a higher multiple, but this is a much bigger gap than normal. Now, I don't think that this means any sort of collapse or anything for the growth stocks. And I think the S&P is on track for perhaps 8 to 10%, and that includes all the stocks. But I think we could have the value sector of the market do 15%.
Wow. I do feel, though, Jeremy, as though we could come into every year for the past, I don't know how many, 10, and say it's going to be value stocks this year. And then as the year ends, we're all like, we should own the growth.
Well, 2022 was fantastic for value, and then it just totally got reversed in 2023, and everything was was zero. So we're in that alternating fashion. But I think the ratios here favor. I'm not saying that growth is it's nothing like 2000, nothing crazy. As you pointed out, ratios are not much greater than they were 20 years ago. But look at interest rates are much greater. And so that is one thing that might tend to hold them back. Interest rates are going to go down short term, but I don't think a lot long term, certainly not to the levels that we had, pre-pandemic, that so boosted those stocks during that period.
Yeah, of course, a recession, as well as what happens with monetary policy, a big indicator here. Raymond James writing in a note this morning, the equity market seems as convinced about a soft landing today as it was convinced of a recession in 2022. Where are you on that camp? And do you think that conviction is more accurate this year than perhaps it was a year ago?
Yeah, it's certainly looking more likely. I give it I give a soft landing, probably 2-to-1 probability. But look, if it's not going to be a soft landing, I think it's going to be a very mild recession, and I think we're going to be coming out of it. And I don't think that should long term or even for 2024 greatly affect the whole year's performance. So even if we do have some softness that dips into zero GDP growth, second and third quarter, that's the worst scenario. And I see a nice growth after that in 2024, 2025. And by the way, I still think the soft landing is still now the most likely scenario. Little dip in GDP growth, not to negative levels, and then acceleration toward the end of the year.
All right. We're going to have plenty of times to talk to you during the course of this year, but certainly appreciate starting off with you, Professor Siegel. Thank you.